What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we're going to be taking a look at shares of Microsoft. I personally do believe that the market is undervaluing the shares right now, and I do believe, even though shares have popped off a little bit recently, I do believe that shares are still significantly undervalued. But as always, this video is not investment or financial advice and is solely for entertainment purposes. All values that you'll see within this video are as of market close on June 3rd, 2026. So let's dive right in here to the past 1 year performance of Microsoft shares. You can see that within that time period, shares of Microsoft underperformed the S&P 500 by negative 35%. Also, on a year-to-date basis, shares have underperformed as well by almost 20%, with the S&P 500 producing an 11% return, whereas Microsoft shares produced a negative 11% return. Over the past week, we have seen an outperformance of Microsoft shares relative to the index, but when we compare Microsoft to the software sector as a whole, which is the benchmark that we compare it to its peers, Microsoft shares have significantly lagged other software names such as Oracle, ServiceNow, Snowflake, Salesforce, and other names. We can see here in February a sharp sell-off in the name and really went down all the way until the end of March. That was from the Q1 earnings release, where revenues missed and forecasts missed as well. But a lot of that revenue miss was because of supply chain issues where they had to divert a lot of their server capacity and physical products internally, which obviously means if you're not selling externally, you are lowering your revenues. We can see really from April, shares have had a nice pop and have traded above that 50-day moving average in the green line. They did take a peek above the 200-day moving average. That is that orange line. What we like to see here is over the past 2 months, we've seen a convergence between the 50-day moving average in the green and 200-day moving average in the orange. If we see continued upward momentum in shares of Microsoft, we should see in due time that 50-day moving average cross over the 200-day moving average, which does indicate a technical buy signal. Let's see how that plays out. But a few key items I want to point our attention to. First, I'll start with the earnings per share there. We can see at the bottom left through 25, 26, and 27, you're looking at around 20+% earnings per share growth over that time frame. I do believe that management will be able to execute on these projections, and they have a track record of doing so. Microsoft does pay a measly 0.9% dividend, which in turn leads to a $3.64 per share per annum. When we look at the fundamentals of the company, Microsoft is growing. You see that sales growth over the past 12 months of almost 18%, gross margins of almost 70%, net margins of almost 40%, and return on equity even at 34%. With all the CapEx spending that they've been doing over the past few years, that does, in turn, when you're spending so much, will shrink your margins and shrink your returns on equity, assets, invested capital, and total capital in the short run. You do see those returns pay off over the long term. I wish it would be easy just to make money overnight, where Microsoft invests internally into its AI build out, let's say, and sees a return on that investment within the coming quarter. It just doesn't work out that way. So as time progresses, we should see these margins expand and returns increase after CapEx is scaled back. When we look at technicals, look at that forward PE of 22.2, price to sales of 10, even price to book at 7.7 is not an overvalued name, with fundamentals growing and also trading well below the 5 and 10-year averages, almost at those 5 and 10-year lows on technical valuations. So this does set up Microsoft shares right now to be a good value name for investors long term. And you see that with the 54 analysts who cover Microsoft shares who have an average price target of $559.96. That does imply an almost 31% return. Even the most pessimistic analyst has a $400 price target, implying shares dropping around 6.4%, and the most bullish analyst having shares more than double from where they're trading on June 3rd, 2026, with 50 plus analysts covering the name to have an average price target of 31% returns is quite incredible, and does show that the institutional money, the quote unquote smart money, does feel that the market is undervaluing the name right now. And you see that with the fundamentals growing, sales growing, and we'll continue to see that. And with projected growth, I don't see how shares can continue to decline. Leave a comment down below as to why you think this is the case. But I do believe that shares are undervalued today. And you see that on that 5-year trend as well. Look at that forward PE, currently at a 22.2. The average is 28.9. And the 5-year low is 19. So we're not too far off from the 5-year low. And also the 10-year averages look fairly similar to this as well. When we look at these valuation summary, you can see all these valuation metrics trading well below the 5-year averages and almost at their 5-year lows, in some cases at their 5-year lows. So Microsoft today is trading at its cheapest valuation in years. And when we compare that to its peers, now I do believe Oracle is a great company. Apple, even IBM. We did cover all these companies in a previous video, so go check those videos out, guys. The story I don't believe is a ServiceNow. You can touch on that in a later video. But for now, we'll keep our focus on Microsoft, looking at it on its forward PE, trading at the cheapest of the group, other than OpenText, which trades on the Toronto Stock Exchange, with great fundamentals relative to the group. Again, Oracle is a great company. Even Apple, with it not spending as much on its AI build out, rather focusing on partnerships, they're having their returns on assets and equity look phenomenal. Look at that return on equity for Apple at 171.4%. Even Oracle at 85.4% return on equity. These are all great companies. Margins of Microsoft, again, at almost 70%, the highest of the group other than ServiceNow. But when we compare it to ServiceNow, which has gross margins of 77.5%, but such a significant compression in margins when we look at that from gross to net margins on ServiceNow are 13.2%. Not an operationally efficient business whatsoever. I know shares have popped. I do believe that's just short-term trading, just due to technicals really showing that ServiceNow shares trading below 100 were extremely oversold, even in the $80 range. Again, we'll point our attention to Microsoft, looking at the highest return on assets outside of Apple. Even when we look at the operational business, you can see that revenue per employee for Microsoft is the highest of the group, again, outside of Apple. So you're getting a great company with great margins, great returns on assets, great track record of delivering growth in earnings per share, and yet the company shares are trading at almost their 5-year lows. Is almost a steal today. Again, everything trending in the right direction. Margins have come down over the past couple years just with the heavy capex, really since 2024. And you also see that in those returns on assets, equity, total capital, and invested capital, a decline over the past 3 years in those bar charts. Again, we should see these returns on these investments showing up in coming quarters, in the coming years. So let's see how that plays out. But like I mentioned, Microsoft is an amazing, operationally efficient business. You see that revenue per employee continuing to grow over the past 5 years, and that net income per employee also rising steadily and trending in the right direction, and is projected to continue to trend in the right direction as they implement AI into their day to day services and tasks, which should deliver better returns and higher numbers in both these revenue and net incomes per employee. And we're seeing those revenues. Look at those 5 and 10 year compounded annual growth rate numbers. Very beautiful, very healthy. Revenues at 14.5%, 5 year compounded annual growth rate, 11.7% on a 10 year. You're even looking at those earnings per share, 10 year, 24%, 5 year CAGR, almost 18%. I should say almost 20%. And we're looking at net incomes all increasing. All these graphs are moving in the right direction. So fundamentally speaking, Microsoft shares are looking very healthy today. Now, with all that cash, you may ask, what are they doing? Yes, that $190 billion that they said earlier on in the year for its AI build out and CapEx, a lot of the money that they've been earning and producing has gone towards that, but they have steadily increased their dividends, but at the cost of share repurchases. Depending on how you look at it, share repurchase may be more tax efficient than having the dividends, but if you prefer the income, then this is a win for you in holding Microsoft shares and seeing those dividends increased year over year. And here's just a revenue breakdown per geography. The US will always comprise, I believe, the largest portion of earnings, but the EU really, I think that's a major growth point for Microsoft with the partnerships that they have. Remember, 80% of the Fortune 500 companies are tied to the Microsoft ecosystem, and the EU as well plays a part of that. Also, with the growth in India and their economy and the boom that they're seeing in their business sector, with more businesses coming online, let's say, there's only a handful of players that will win market share in the growth of India. And I do believe Microsoft is, if not a winner, will be a leader in that region. Let's see, but that is a significant growth area for India. That is a major growth focus area for Microsoft shares. I will say that mainland China, we should continue to see declines in revenue in that region, just with geopolitical issues and the internal development of AI companies within China, and also the cloud businesses that are in China. So within this video, we have really touched on a lot of the fundamentals and technicals as to why Microsoft shares are a good buy today. But I want to leave you guys with a few points here. Microsoft is one of the most dominant players in the cloud space. They have a $627 billion backlog that they reported in the most recent quarterly reports. That does imply a doubling of that backlog year over year, and that is because of those supply chain constraints. I'd rather see a company have supply chain issues than have product development issues, customer issues, and so forth. So I believe that backlog will be a nice boost to earnings over the coming quarters. And you see that cloud revenue jumping also 29% year over year in the Microsoft Azure space. For such a large company to see that type of growth is incredible. And like I mentioned, 80% of the Fortune 500 companies use or are a part of the Microsoft ecosystem. And as they roll out new products and new AI products for their customers and users, I do believe that will create a sticky ecosystem that makes it harder for these companies to transition to one of Microsoft's competitors. And recently, we've been seeing a lot in the news the NVIDIA deal where they are going into personal computing chips. I do believe this will be a big win for Microsoft, as a lot of people will upgrade their computers, and Microsoft will have that trickle down effect through their ecosystem and software they provide to these personal computers. So we should see a nice boost to the personal computing space for all companies, even including Dell. I think this will be a big threat for Intel, not so much AMD, but I did create a bearish video on Intel previously. Go check that out as to why I think Intel is definitely not a buy. And this was before this release of NVIDIA getting into the personal computer space. Not looking good for Intel, but looking good for Microsoft. And also, we're looking at strong positive technicals with shares indicating an oversold metric. But hey, let's see how this will pan out for investors long term. This is only my personal opinion. This is not investment or financial advice. I appreciate you guys making it to the end of the video. Please do hit that like and subscribe button and stay tuned for the next video.